What if I told you that the money in your wallet could be obsolete in the next decade? That the financial system as we know it, banks, credit cards, even cash, could be replaced by something entirely digital, decentralized, and untethered from governments? Sounds like science fiction, right? But this is exactly what cryptocurrencies like Bitcoin, Ethereum, and thousands of others are promising. Yet for every story of someone becoming a millionaire overnight thanks to crypto, there's another story of someone losing everything. So what's the truth? Is cryptocurrency the future of finance? Or is it just a massive bubble waiting to burst? And more importantly, should you care? By the end of this video, you'll understand why crypto is so polarizing, how it could reshape the global economy, and whether it's worth your time or your money. Let's dive in. What is cryptocurrency and why does it exist? To understand whether crypto is the future or just a fad, we need to start with the basics. What exactly is cryptocurrency and why was it created in the first place? Cryptocurrency is a digital or virtual form of money that uses cryptography for security. Unlike traditional currencies issued by governments, like the US dollar or the euro, cryptocurrencies operate on decentralized networks based on blockchain technology. This means no central authority, like a bank or government, controls them. The first and most famous cryptocurrency, Bitcoin, was created in 2009 by an anonymous person, or group, known as Satoshi Nakamoto. The timing wasn't a coincidence. Bitcoin was born in the aftermath of the 2008 financial crisis, a period when trust in banks and governments was at an all-time low. Nakamoto's vision was simple: create a currency that was free from government control, immune to inflation, and accessible to anyone with an internet connection. But Bitcoin was just the beginning. Today, there are over 20,000 cryptocurrencies in existence, each with its own unique features and use cases. Ethereum, for example, introduced the concept of smart contracts, self-executing contracts with the terms directly written into code. Others, like Ripple, XRP, aim to revolutionize cross-border payments, while meme coins like Dogecoin started as a joke, but have gained serious traction. So why does crypto matter? Because it challenges the very foundation of our financial system. For centuries, money has been controlled by governments and banks. Cryptocurrency flips that model on its head, giving power back to the people. But is that a good thing? Let's explore the case for cryptocurrency as the future of finance. Proponents of cryptocurrency argue that it's not just the future of finance, it's the inevitable future. Here's why. 1. Decentralization and financial freedom. The most compelling argument for crypto is its decentralization. Traditional financial systems are centralized, meaning they're controlled by a handful of institutions. This centralization creates vulnerabilities, like the 2008 financial crisis, where reckless behavior by banks led to a global economic meltdown. Cryptocurrencies, on the other hand, operate on decentralized networks. No single entity controls the system, making it more resilient to corruption, censorship, and manipulation. For people in countries with unstable governments or hyperinflation, like Venezuela or Zimbabwe, crypto offers a lifeline, a way to store wealth outside the control of corrupt regimes. 2. Financial inclusion. Did you know that nearly 1.4 billion people worldwide don't have access to a bank account? Cryptocurrency has the potential to change that. All you need to use crypto is a smartphone and an internet connection. This makes it accessible to anyone, anywhere, regardless of their socioeconomic status. In countries like Nigeria and Kenya, crypto adoption is skyrocketing, not just as an investment, but as a practical tool for everyday transactions. For millions of people, crypto isn't just a speculative asset. It's a way to participate in the global economy. 3. Innovation and efficiency. Blockchain technology, the backbone of cryptocurrency, is revolutionizing industries far beyond finance. From supply chain management to healthcare, blockchain's ability to create transparent, tamper-proof records is transforming how we do business. In finance, crypto eliminates the need for intermediaries like banks and payment processors. This reduces transaction fees and speeds up processes. For example, sending money across borders using traditional methods can take days and cost a fortune. With crypto, it's instant and costs pennies. 4. Hedge against inflation. With governments around the world printing money at unprecedented rates, inflation is a growing concern. Cryptocurrencies like Bitcoin have a fixed supply. Only 21 million Bitcoins will ever exist, making them inherently resistant to inflation. This has led many to view crypto as a modern-day digital gold, a store of value in uncertain times. The case against cryptocurrency, is it just a bubble? For all its potential, cryptocurrency is far from perfect. Critics argue that it's not the future of finance, but a speculative bubble waiting to burst. Here's why. 1. Volatility. If you've ever looked at a Bitcoin price chart, you know how wild the ride can be. In 2021, Bitcoin hit an all-time high of nearly 69,000, only toe crashed to around 16,000 by the end of 2022. This kind of volatility makes crypto a risky investment and a poor medium of exchange. After all, would you want to buy a coffee with Bitcoin if its value could drop 10% by the time you finish your latte? 2. Lack of regulation. While decentralization is one of crypto's biggest strengths, it's also one of its biggest weaknesses. The lack of regulation has made the crypto space a breeding ground for scams, fraud, and illegal activities. From Ponzi schemes to ransomware attacks, crypto's anonymity has attracted bad actors. Even legitimate projects can fall victim to hacks. In 2022, the collapse of the crypto exchange FTX wiped out billions of dollars in investor funds overnight. Stories like these have led many to question whether crypto is too risky to be taken seriously. 3. Environmental concerns. Cryptocurrency mining, especially for Bitcoin, is incredibly energy intensive. The Bitcoin network consumes more electricity than entire countries like Argentina or Norway. This has raised serious concerns about crypto's environmental impact, particularly as the world grapples with climate change. While some cryptocurrencies are moving to more energy-efficient models, like Ethereum's transition to proof of stake, the industry as a whole has a long way to go to address these concerns. Speculation over utility. Let's be honest, most people who buy crypto aren't doing it because they believe in the technology. They're doing it because they want to get rich quick. This speculative frenzy has led to the creation of thousands of worthless coins, many of which are outright scams. The question is, how much of crypto's value is based on real utility and how much is just hype? If the bubble bursts, the consequences could be catastrophic. The bigger picture, what does the future hold? So, where does this leave us? Is cryptocurrency the future of finance, or is it just a bubble? The truth is, it's probably a bit of both. On one hand, the underlying technology, blockchain, is here to stay. Its potential to revolutionize industries and create a more transparent, efficient, and inclusive financial system is undeniable. Governments and corporations are already exploring ways to integrate blockchain into their operations, from central bank digital currencies, CBDCs, to supply chain management. But let's dig deeper into what this really means for the future. Blockchain beyond cryptocurrency. While cryptocurrencies like Bitcoin and Ethereum grab most of the headlines, the real game changer is blockchain technology itself. Blockchain is essentially a decentralized ledger that records transactions across a network of computers. This ledger is immutable, meaning once data is recorded, it cannot be altered or tampered with. This feature alone has massive implications for industries far beyond finance. Take supply chain management, for example. Companies like Walmart and IBM are already using blockchain to track the journey of products from farm to table. By recording every step of the supply chain on a blockchain, companies can ensure transparency, reduce fraud, and improve efficiency. Imagine being able to scan a QR code on a product and instantly see its entire history, where it was made, who handled it, and how it got to you. That's the power of blockchain. In healthcare, blockchain could revolutionize how patient data is stored and shared. Instead of fragmented records spread across different hospitals and clinics, blockchain could create a unified, secure system where patients control access to their own data. This could lead to better diagnoses, more personalized treatments, and fewer medical errors. Even the art world is being transformed by blockchain. Non-fungible tokens, NFTs, which are unique digital assets stored on a blockchain, have created a new market for digital art and collectibles. While the NFT craze has its fair share of skeptics, the underlying technology has the potential to redefine ownership and intellectual property rights in the digital age. Central bank digital currencies, CBDCs, the government's answer to crypto? As cryptocurrencies gain traction, governments around the world are taking notice. But instead of embracing decentralized cryptocurrencies, many are developing their own digital currencies, known as central bank digital currencies, or CBDCs. These are essentially digital versions of a country's fiat currency, issued and regulated by the central bank. China is leading the charge with its digital yuan, which is already being tested in several cities. The European Central Bank is exploring a digital euro, and the U.S. Federal Reserve is researching the possibility of a digital dollar. Even smaller countries like the Bahamas have launched their own CBDCs. So why are governments so interested in CBDCs? For one, they offer greater control over the monetary system. Unlike decentralized cryptocurrencies, CBDCs are fully regulated and can be used to implement monetary policies more effectively. They also provide a way to combat the rise of private cryptocurrencies, which governments see as a threat to their control over the financial system. But CBDCs also raise concerns about privacy and surveillance. If every transaction is recorded on a government-controlled blockchain, it could lead to unprecedented levels of monitoring. This has sparked debates about the balance between financial innovation and individual privacy. The speculative nature of crypto, a necessary evil. On the other hand, the current state of the crypto market is undeniably speculative. Many of the projects that exist today will fail, and investors will lose money. But this doesn't mean crypto itself is doomed. Just like the dot-com bubble of the late 1990s, the crypto bubble may be a necessary step in the evolution of a new technology. During the dot-com bubble, countless internet companies went bust, but the ones that survived, like Amazon and Google, went on to change the world. Similarly, while many cryptocurrencies will likely disappear, the ones with real utility and strong fundamentals could become the backbone of a new financial system. The key is to separate the signal from the noise. While it's easy to get caught up in the hype, it's important to remember that crypto is still in its infancy. The real value of cryptocurrency won't be determined by price charts or memes. It will be determined by its ability to solve real-world problems. With the role of regulation in shaping crypto's future. One of the biggest challenges facing the crypto industry is regulation. Right now, the regulatory landscape is a patchwork of different rules and standards, varying widely from country to country. Some governments, like El Salvador, have embraced crypto, even making Bitcoin legal tender. Others, like China, have banned it outright. In the U.S., the Securities and Exchange Commission, SEC, has been cracking down on crypto projects that it deems to be unregistered securities. This has created uncertainty for both investors and developers, slowing down innovation in the space. But regulation isn't necessarily a bad thing. In fact, it could be the key to crypto's long-term success. Clear, consistent regulations could provide the stability and legitimacy that the industry needs to grow. It could also protect investors from fraud and scams, which are all too common in the crypto world. The challenge is finding the right balance. Too much regulation could stifle innovation, but too little could leave the door open for bad actors. As the industry matures, finding this balance will be crucial. The environmental question, can crypto go green? Another major issue facing the crypto industry is its environmental impact. Bitcoin mining, in particular, has come under fire for its massive energy consumption. According to some estimates, the Bitcoin network consumes more electricity than entire countries like Argentina or Norway. This has led to growing calls for the industry to adopt more sustainable practices. Some cryptocurrencies, like Ethereum, have already made strides in this direction by transitioning from proof of work, which requires massive amounts of energy, to proof of stake, which is much more energy efficient. But the industry as a whole still has a long way to go. If crypto is to become a mainstream financial tool, it will need to address these environmental concerns head-on. This could involve everything from using renewable energy for mining to developing new, more efficient blockchain technologies. Capture the future of finance. A hybrid model? So what does the future hold for cryptocurrency? It's unlikely that crypto will completely replace traditional finance. Instead, we're likely to see a hybrid model where cryptocurrencies and blockchain technology coexist with traditional financial systems. In this model, cryptocurrencies could serve as a complement to fiat currencies, offering an alternative for those who want more control over their money. Blockchain technology could be integrated into existing financial systems, improving efficiency and transparency. At the same time, governments and corporations will continue to play a major role in shaping the future of finance. Whether through CBDCs, regulated crypto exchanges, or new blockchain-based services, the lines between traditional finance and crypto will continue to blur. Conclusion: the evolution of money. The story of cryptocurrency is still being written. It's a story of innovation, speculation, and the ongoing struggle to redefine what money means in the digital age. Whether crypto ultimately succeeds or fails, one thing is clear: it has already changed the way we think about money, finance, and the global economy. As we move forward, the key will be to focus on the real value that crypto and blockchain technology can provide. This means looking beyond the hype and speculation and focusing on how these technologies can solve real-world problems. Only then can we truly understand whether cryptocurrency is the future of finance or just a bubble waiting to burst. What do you think? Is crypto the future, or is it just a bubble? Let me know in the comments below, and if you found this video helpful, don't forget to like, subscribe, and hit that notification bell. Thanks for watching, and I'll see you in the next one.